picture this. You have spent 30 years doing everything right. You maxed out your retirement contributions year after year. You stayed in the market through the drops that made everyone around you nervous. You resisted the urge to sell when the headlines turned ugly. And now, somewhere in your late 50s or early 60s, the portfolio looks, honestly, pretty solid. The number on the screen is real. It took decades to build. And yet something does not quite add up. Here is what almost nobody warned you about. It is not the crashes that quietly destroy retirement portfolios. It is not the market corrections, the bad years, the recession headlines, or the inflation scares. Those are loud and obvious, and there is no shortage of people writing about them. The thing that actually drains retirement wealth, the thing that works slowly, silently, over years and years, is already sitting inside the portfolio right now. Already in there. Looking completely fine on the surface. A great deal of time goes into thinking about why some people reach retirement feeling genuinely free, while others arrive at that same moment and realize, with a kind of slow dawning dread, that the math simply does not work the way they thought it would. The gap between those two outcomes is almost never about income. It is almost never about how much someone earned over a career. It is usually about what they were holding. So today covers 6 assets, things that appear completely normal, things that rarely get flagged as problems, things that do not show up on any obvious danger list, that quietly erode retirement portfolios from the inside. Some of these may feel uncomfortably familiar. Start with the one most likely to make people uncomfortable. The family home. To be clear, home ownership is not the problem. The problem is treating the home as the primary retirement asset, as the plan itself. And a significant number of people are doing exactly that without fully realizing it. Here is a version of this story that plays out repeatedly. Someone spends decades paying down a mortgage and watching the equity accumulate. The home appreciates, especially if they bought at a reasonable time and held through a couple of boom cycles. By their late 50s, they do the rough math and realize the home is worth perhaps $600,000, and they feel a sense of relief. They feel like retirement is covered. But here is where the thinking quietly goes wrong. A house does not pay you. It does not generate income unless you sell it, rent it out, or take on a product like a reverse mortgage, which carries its own significant complexity and cost. Most people have no intention of selling the home where they raised their family. Most people are not going to become landlords at this stage of life. And most people carry a mix of emotional and financial resistance to reverse mortgages that tends to keep that option off the table as well. What remains is an enormous amount of wealth locked inside an illiquid asset that also costs money every single month to maintain. Property taxes, insurance, repairs, utilities, and that money has to come from somewhere. The real danger is not owning a home. The real danger is treating the equity in the home as equivalent to retirement income. One is a number on paper. The other is money available each month when the bills arrive. In retirement, that distinction is everything. The useful exercise here is to model out what retirement income actually looks like with the home equity completely set aside. If that picture is uncomfortable, it is far better to discover that now than at 67. Whole life insurance occupies an almost mythological status in certain corners of the financial world. It gets sold with genuine enthusiasm, and it is possible to understand why, because the pitch is genuinely appealing on the surface. Premiums get paid, a cash value builds over time, that cash value grows on a tax-deferred basis, and it can be borrowed against in retirement, all while providing a death benefit for the family. It sounds like a savings account and life insurance combined into a single elegant solution. There are scenarios in which this product makes real sense. For the vast majority of people using it primarily as a retirement savings vehicle, however, it is quietly and persistently consuming their future. The costs embedded in whole life policies are substantial. Internal expense ratios, mortality charges, administrative fees, and surrender charges for anyone who decides to exit early, all layering on top of one another in ways that are genuinely difficult to parse even for financially sophisticated people. $1 going into a whole life policy is doing significantly less work than $1 going into a low-cost index fund inside a Roth account. Over 30 years, that difference is not a rounding error. It is enormous. There is also an emotional dimension that makes this asset particularly difficult to walk away from. After years of payments and a cash value sitting there on the statement. Leaving the policy feels like throwing money away. That sunk cost psychology keeps people in products that are costing them far more than they recognize, year after year, well into their 50s and 60s. The appropriate response is not a panicked or impulsive decision. It is an independent analysis from a fee-only financial advisor who does not earn commissions on insurance products. Someone who can show clearly what the policy is actually returning after all costs are accounted for. That answer is often genuinely eye-opening. High-cost, actively managed funds present a version of this same problem, and they are everywhere. They appear in workplace retirement plans, in individual accounts, and they get marketed constantly as the sophisticated investor's choice. The narrative is seductive. A team of analysts studying market data, making strategic decisions, generating returns that beat the broader market. The investor is paying for expertise and for edge. Except decades of research, overwhelming in its volume and consistency and difficult to argue with on the merits, shows that most actively managed funds underperform their benchmark index over long time horizons. Not a portion of them, most of them. And the funds that do outperform in a given year, or even across a given decade, have a poor track record of sustaining that outperformance going forward. Past performance genuinely does not predict future results, which is not just legal boilerplate, but an accurate description of what the data shows. The especially damaging element is the fees. A fund carrying a 1.2% annual expense ratio sounds almost trivial, barely over 1%. But compounded across 20 or 30 years, that fee transfers a meaningful portion of total portfolio growth to the fund company. Not as a reward for superior performance, but often despite the fund having failed to outperform. Consider two versions of a $1 million portfolio, both returning 7% annually. One carries an expense ratio of 0.05%. The other carries 1.2%. Over 20 years, the difference in ending value is roughly $250,000. $250,000, not lost to a crash, not lost to a bad year, simply transferred in the form of fees, silently, every year. For anyone within 10 or 15 years of retirement who has not examined the expense ratios across their holdings, that audit may be the highest return 30 minutes available this year. Concentrated single-stock positions are interesting because they almost always arrive with a compelling story. The shares came from an employer. Person 1 got into a position early on, a company that grew into something significant. The holding feels personal rather than purely financial. There is pride attached to it, sometimes a sense of identity, which is precisely what makes it so difficult to act on and precisely what makes it dangerous. There is a version of this story that ends well. Person 2 holds a large position in a company that keeps climbing, sells at a reasonable moment, and retires comfortably. Those stories get told because they are satisfying. What gets told far less often, because loss is a less comfortable narrative, is the story of someone who had $300,000 of retirement wealth concentrated in a single company. And then that company had a difficult year, or a scandal, or simply declined steadily over a decade. By the time retirement arrived, the position had lost 60, 70, 80% of its value. This happens regularly. It happened with well-known companies whose collapses became headline stories. It happens with smaller companies nobody writes long articles about, to real people every year. Most financial planners suggest that no single stock should represent more than 5 to 10% of a total investable portfolio, and even that upper range makes many advisors uncomfortable. As retirement approaches, the asymmetry becomes more pronounced. More is at stake, there is less time to recover, and the positions most likely to be oversized are the ones that feel most familiar and most trusted, which is its own form of cognitive risk. If a concentrated position carries a large embedded gain, yes, there are tax implications to unwinding it. But there are also strategies: systematic selling across multiple tax years, charitable vehicles, exchange funds, that can help manage the tax exposure without leaving the portfolio fully exposed to a single company's fate deep into the pre-retirement years. Annuities occupy a complicated place in retirement planning. There are simple, low-cost, income-focused versions of this product that serve a genuine purpose. A straightforward immediate annuity that converts a lump sum into guaranteed monthly income for life can make complete sense in the right context. The products most aggressively sold to people approaching retirement, however, are frequently not those products. They are variable or indexed annuities layered with riders, features, and guarantees. Wrapped in prospectuses that are difficult to read even for careful readers. And they come with surrender periods, sometimes 7 years, sometimes 10, during which the account holder cannot access their own money without paying a penalty that can reach 10%. Person 1 who buys one of these products at 58, when retirement feels close and the promise of guaranteed income is deeply appealing, may not fully understand that a large portion of their savings has been locked into a product inaccessible without penalty until they are approaching 70. They may also not have fully registered that the internal costs of the product, mortality and expense charges, administrative fees, rider fees, may be running at 2.5% to 3% annually. 3% per year in fees on a product intended to build retirement security is a serious drag. If the underlying investments are returning 7% and 3% is being paid out in fees, the effective return is 4%. Inside a structure that cannot be exited without a penalty for years. The warning signs worth watching for are surrender periods longer than 5 years, total annual costs above 1.5%, any product sold by someone earning a large upfront commission on the transaction, and any level of complexity that makes it difficult to explain to someone else in plain language. That last point is genuinely useful information on its own. Real estate investing builds real wealth. That is not in question. People have constructed genuinely serious financial positions through rental properties, and it remains one of the more powerful wealth-building vehicles available to someone with the capital, the temperament, and, importantly, the time and bandwidth to manage it. The version that quietly erodes retirement portfolios is a specific one. It is the rental property that made excellent sense when it was purchased, in a different season of life, when the mortgage was smaller, when vacancy periods and repair calls were manageable inconveniences rather than genuine financial stress. The decision was sound at the time. But real estate is an active asset. Even with a property management company handling the daily operations, there are decisions to make, calls to take, and problems to solve. A roof that needs replacing, a tenant who stops paying, a vacancy that stretches 2 months beyond expectations. During the accumulation phase of life, those situations are annoying but absorbable. In retirement, when monthly cash flow is fixed and the tolerance for financial stress is lower and the time horizon for recovery is shorter, the same situations feel qualitatively different. There is also the liquidity issue. Real estate, like the family home discussed earlier, cannot be partially liquidated if the market shifts, if capital is needed quickly. If the property stops producing the cash flow it once did, the only option is to sell the entire asset at whatever price the market offers at that moment, which may or may not align with what is actually needed. None of this is an argument for selling every rental property at 60. It is an argument for building an honest model. What does the actual cash flow look like after taxes, after property management costs, after maintenance reserves? Is the asset earning its place in the overall picture? And is the ongoing lifestyle cost, the attention, the decisions, the occasional stress actually worth the financial return it is producing? For some people, the answer is genuinely yes. For others, it is a quiet drain on both finances and peace of mind that has simply never been examined clearly. Here is the thread that runs through all 6 of these. None of them are scams. None of them are obviously wrong. Each of them made a certain kind of sense at some point. In some context, the family home built real equity. The whole life policy felt like security. The actively managed fund seemed like a sophisticated choice. The concentrated stock position had a meaningful story behind it. The annuity offered the comfort of certainty. The rental property produced income. The problem is not that these assets are inherently bad. The problem is that they are quietly expensive, or quietly illiquid, or quietly misaligned with what retirement actually requires. And that mismatch can accumulate over years without anyone raising a flag, because nothing appears obviously broken from the outside. Retirement does not punish large visible mistakes as much as it punishes small persistent ones. A 1% fee does not feel significant in year 1. A concentrated position does not feel dangerous while it is growing. An illiquid asset does not feel like a problem until liquidity is suddenly what is needed most. And then, all at once, the accumulated weight of those quiet erosions becomes visible at precisely the moment when there is the least runway left to correct them. The most useful thing to take from any of this is simply the habit of looking clearly. Audit what is actually being held and what it is actually costing. Not what a brochure suggested, not what a salesperson described, but what the math shows when it is done honestly, with a low-cost alternative as the point of comparison. Decades of work went into building what is there. The least it deserves is a clear-eyed look at what might be quietly working against it. If this gave you something worth thinking about, share what landed for you in the comments. Like the video if it was useful, stay subscribed for more of this kind of thinking, and the next one will be along soon.